Welcome to The Economy. How do you measure that? Where we explore the fascinating world of macroeconomic statistics, how we measure what's happening in the economy one transaction at a time. I'm your host, Jim Tebrake, Deputy Director of the IMF Statistics Department. Today we're looking into something we often hear in the news headlines, markets soar or investors lose billions. But here's the real question. When share prices rise or fall, do we actually see that reflected in the way we measure economic growth? To help us answer this question, I'm joined by Barend from the South African Reserve Bank. Thanks for joining us, Barend.
Well, thank you very much for having me, Jim. And I know this is a topic that often confuses people, so I'm quite excited to shed some light on it.
All right, so let's start with the basics. If the stock market rises, does that mean the economy is growing?
Well, not necessarily, Jim. I mean, GDP measures production income and spending in a given period. But when stock prices go up or down, nothing is really being produced, so nothing new is added. It's basically just a change in the value of the existing assets, so it doesn't count toward GDP.
Okay, so stock market takes off, GDP flat, up, down, doesn't really have any relation. But now what about if my retirement fund grows because of these rising stock prices? Do I count that as my income? Do I kind of walk around just with a lot more money on the bank? How does that work?
Well, you might find this surprising, but we don't actually call it income. It's what we call holding gains. And they can obviously be holding losses as well. So your asset has become more valuable, but you haven't earned income from it. So these changes, they do impact the wealth that you have. So basically your household wealth. But in essence, they're not counted as income. So at the aggregate level, we see changes in the national balance sheet, but not in GDP or national income. And they purely reflect changes in wealth, not production.
Okay, what about if I sell those shares? So those shares went up. I said, hey, I've heard you need to buy low, sell high. I'm selling high. Is that my income?
Well, sorry to say, but even then it's not income in the way GDP defines it. You're basically just swapping one asset, which is now shares in this instance, for another asset, which is cash held as a deposit, most probably at the deposit-taking corporation. So there's no new production involved, and the sale is then recorded in the financial accounts, but it doesn't boost GDP. That's the issue.
Okay, well, this is great, Barend, because this really helps explain how a country's wealth can go down without it being in a recession.
Well, I mean, Jim, that's exactly the point. So asset prices, like stocks or real estate or any asset price, can rise and fall dramatically, and that obviously impacts the household and the corporate balance sheets. But unless that wealth is turned into spending or investment, GDP will just stay the same.
Well, Barend, that really clears up a big misconception. GDP tracks what we make and spend, not the ups and downs of the stock market. Thanks to Barend for joining me today. That wraps up this episode of The Economy. How do you measure that? If you found it insightful, don't forget to like, subscribe, and share. And remember, behind every economic activity, there's a statistician like Barend figuring out how to measure it. Thank you.